All right, we got Alex with Accruity. Accruity is a new company that we had never heard of before until last month.
I'm excited.
But when we talked to them, we had like a series of a whole bunch of questions. I was like, man, this is great. And Alex, the topic today, the tax strategy your CPA isn't telling you as a real estate agent. That's perfect, because I feel like I'm always being pulled around and be like, I think there's more to this. So Alex, quickly, Nick Baldwin, he loves Spider-Man. Jason Northcutt sells land.
Who doesn't?
I need more coffee.
Yes.
Alex, tell us about you.
Man, I've actually never had a sip of coffee in my life. So I'm the opposite.
Oh, I like that.
Kristen, I've never had
what, dude?
Yeah.
I mean, at this point, it's like, why start?
I can't start now.
Don't do it.
38 years clean.
But he's hopped up on about 17 Red Bulls, so there's no difference, really.
Exactly.
Little Alani, little magnesium. We're good.
We're good.
Adderall medicines.
Alex, tell us about Accruity, because you have so many layers to this, and then let's get into the tax.
A lot of layers to it. Yeah, I'll give you guys just a little background here with me and myself too. Everybody can see my screen too. Yeah, perfect.
Yep, got you.
So we're part of Steel Point Capital, which is one of the partners there. We're focused on a lot of different businesses, all centered around real estate, portfolio, property management. We've got flooring and paint. We've just launched a new marketing agency. We've got a lending business, and of course, Accruity, which is a real estate focused accounting firm. Really, there's so much nuance to the accounting world from a real estate perspective that CPA down the street, bookkeeper down the street just might not be familiar with. And if you're running just an out-of-the-box strategy and out-of-the-box system, you're probably leaving money on the table. And so we're here today just to kind of give you the full strategy around that. Of course, there's all my contact info and social media, and always like to give, I'm a new dad too, so that's kind of the cool thing.
All right, guys, take a picture of that, because you're going to have questions. I can already tell you. You're going to have questions for Alex. Follow her girl.
Yes, little girl. She's going to be 6 months next week, so she's dramatically bigger than what she is there.
Dude, if you ever needed Red Bull, now's the time. Seriously. Now if you needed coffee, now's the time to take up coffee.
For sure.
Not sleeping.
So funny.
But kind of here's the reality of the accounting CPA world. Most of our people in our industry, they're working with that historical CPA who gives them a call in the spring. They say, hey, send me all your docs, send me access to your books. I'll get you filed. And they're not diving into the strategy around how can I save you money? They might get you processed on time, which is great. That's a huge element, but you're likely leaving money on the table. Our model is to have consistent interaction with our clients. There's a multitude of services we offer, like bookkeeping, reporting, payroll, etc. But tax strategy is something that we believe should be at the forefront of that. So we're doing routine check-ins, typically quarterly, to make sure you are on track for your tax plan. So you're not waiting till December around Christmas time to go find deductions and go find depreciations. It's all about staying on track on the plan. So we consider ourselves really the full tax strategist side of all this.
December, talking about April 14th. You know what I mean? Like the day before, people are like, "Oh my God, my taxes."
Yeah, we had a guy call us on December 31st last year and said it was like 4:00. He's like, "Can I go buy a car right now for a write-off for this year?" And we're like, "Man, if the dealers are open and you can get a deal done in like 30 minutes, but there's a lot more to that. That's not a proactive strategy that you really want to take advantage of." So the framework we'll run through today and that we've built is really for anybody in the real estate space that's in any of these verticals you see here: agents, team owners, brokerage, wholesales, flipping. Of course, portfolio holders is a large element to that. Typically, if you're making above 100K, that's when really you can start to stack savings on top of each other and really start to work through a combined system.
Really quick, are people that are watching now, are they going to get these slides from you, or you're going to send them over to us?
Yeah, we can send them over to the team. Yeah, I think the team should already have them. So yeah, we'll send them.
We'll send these out after for everyone that registered.
Yeah, and of course, as a preface to all of this, we're using a lot of just simple round numbers for the sake of this discussion. You can kind of input where you would be if you're like, hey, I make this much, so it might be double, it might be a quarter of that, whichever it is. But it's meant to be, knowledge material of how you should do these things. And again, we're using a lot of round numbers. As always, consult somebody at Accruity or a CPA But again, most of this will help just for simple math.
Someone's asking if you just go back to a couple slides.
Yep.
I think that's the one. Sarah in the chat is asking. Maybe she wants
The historian, the strategist.
to grab a
There you
picture
go.
of that
Snap
or
it.
something.
Yeah. And a lot we'll go through today, go back and ask your CPA, hey, did I do this? Why didn't I do this? We'll go through a whole framework of the strategy. So really good way to kind of judge if, they're the right person for your business or not, or if they understand your vertical and what you should be doing or not. So
I love it.
So our example today, we're going to talk about an agent, roughly making like 125,000 in commissions. Again, keep in mind, you might be double that, triple that, less than that. We'll use it for broad numbers. But right off the jump, if you're that person, you're probably going to owe about $13,000 just in federal taxes off of your commission. So we can start to framework a strategy to bring down some of those expenses you run out of your business and different things that can help to pull that down. And if you follow this framework, you can probably get pretty close to zero. I do frame that up as federal taxes. There's a total tax liability that we just can't avoid, things like your local and state and payroll taxes, but there's ways to help maximize those. So even if you're that same person and you have no strategy, you just do straight filing, you're still probably going to be in that 22 range. Like we can pull it probably closer down to, something about 15. The key there though, is really understanding when and how to pay those things. So you're just not blindsided when it comes April, which we see often with clients of, I didn't save anything I put away for taxes. I get hit this bill and now they're telling me I owe $15,000. I don't have $15,000 saved, and it's detrimental to growing and scaling, whichever real estate vertical that you're in. So the way we take this together is really stacking strategies on top of each other because they all will work great individually. But when you see the combined system together, that's where you can really maximize your savings. So think about this as a framework that adds on top of each other. When we start to think about those 5 steps, number 1, we've got entity structuring, making sure your business is set up properly, that you can, 1, protect yourself from liability, not keeping things like in your personal name or running business items to your personal name, but also really understanding the way that you pay yourselves out of which business entity. So that starts to lead into number 2, which is really understanding how should I actually be paying myself, out of what entities, what do I take as distributions, what do I take as salaries. 3rd, this is starting to get into the long-term side, your retirement contributions that you can push for the long term, let them sit. There's a lot of creative ways now through like self-directed vehicles. You can actually use your retirement contributions to further get into real estate, using that to purchase rental properties. That can be short-term, long-term, whichever your style is there. Next is where it gets creative against the real estate side. You can start to tap into bonus depreciation. This is huge for our real estate professionals, and we'll talk more about that. And then last is number 5. These are the low-hanging fruits that, like I said earlier, you want to go make sure to your accountant, you're saying, why am I not doing these things? Because these are ones that every business owner out there should be doing, right now. Here's just kind of, again, that example person. It's an agent. They're filing married jointly. That really matters for real estate professional status. They've got kids. That really matters for getting your kids on payroll tax-free. They qualify as a real estate professional. That, again, matters on helping to offset some of the income. So we'll dive through that further. But this is kind of what it's all based around. So first, when you think about your entity setup, a lot of our clients go and file an LLC and they run their business out of there. There is a higher payroll tax that you would then get hit with on that side. We really want to be running our business through an S-Corp that can own your LLC or multiple LLCs. And that way you can go set a reasonable wage. You can pay yourself out of that S-Corp, and then you will get hit less on the payroll tax side of that. In this example, we set just a reasonable salary, $48,000. Their still take-home pay is going to be the $125,000. We're going to take the rest of that through series of distributions throughout the year, which also through the S-Corp are then less payroll tax on. But we're setting ourselves a reasonable salary, and we're continuing to pay distributions then. With that S-Corp election, you can also then make your QBI election. QBI allows you to take 20% tax just right off the jump for being a business owner. So already right now, we're going to save 20% off the jump. We're going to restructure the way we pay ourselves to essentially drop our payroll tax to as much as possible. And in this exact example there, that's probably around $6,000 to $7,000 of taxes saved. So you get to keep that money in your pocket, reinvest that back into your business. We've not actually done anything different than just move some things around and restructure the payroll process on there. We get that question a lot. Well, am I too small for an S-Corp? Does it make sense for me to have that? Typically, our rule of thumb, when you're in about 80K to 100K in profit, S-Corp will likely save you money. If you're below that, you don't hit quite that number yet, the admin cost of the S-Corps of doing things like your annual filings, your state registrations, they're likely going to push you out of being able to save money on that. So really understand what your profits are, and that's going to help you understand the take home. It's always a cost benefit analysis on that side of, which makes the most sense.
Quick question, Alex, because I know people are thinking it because you hit that mark. Mary is asking a question that a lot of people are thinking. Where's Mary? If take-home pay is less than 100,000, then don't do an S-Corp?
Yeah, again, it's cost benefit analysis on it. An S-Corp does help some liability protection, but you are then going to have more like your tax returns will likely be more expensive. Your state reporting that you have to do every year is going to be more expensive. So what you would save by running the S-Corp likely would be more than just what you would have from keeping an individual LLC. Then the risk there is that there's some potential liability if you're just running everything through one LLC. So it's always a little bit situational. You just have to have cost benefit analysis to that. There's nothing wrong with running an S-Corp, even below those marks. You just have to be prepared that there is additional administrative cost to running that then just might cut into some of the tax savings you could get. Yeah, but it's a really good question. And everyone always asks that, like, when and where do I start? And so this is our rule of thumb on like, how do you actually want to structure your real estate businesses? So hopefully, Mary, this will be a good screenshot for you as well, just to kind of start to see this. At the bottom, you want your property level or your revenue generating LLCs. So if you're an agent and you run that through an LLC, you want to create that to do just agent activities. A lot of our agent clients now, they're also maybe flipping houses. They're maybe holding rentals. You want each of those in their own LLC. And that's how you can also space out some of that liability. Some of those businesses, particularly on the flipping side, they can be litigious, right? Contractor gets hurt on your property. You don't want them coming suing 3 businesses all sitting in one LLC. Now they're basically taking down your whole empire. So you want to segregate out your LLCs based off revenue generating. And typically, even if you're holding properties, our rule of thumb is keep about $1 million of assets in an entity and then create your other one. Same concept there. There's admin cost on that. So if you would go and buy, 10, 15 properties and each one has their own entities, you're doing 10, 15 tax returns, you're doing 10, 15 annual registrations. It's just going to get too much from an admin side.
Quick question, Alex, for me, just so I better understand it. When we're out here in Malibu, Calabasas, parts of Beverly Hills and Bel Air, when people are coming in and purchasing homes, they're putting it into an LLC per property, right? And then putting it into the trust. Go through that process for us.
Yeah, and I think it goes into that rule of thumb, right? Malibu is probably one of the places where that $1 million rule of thumb might be every property, right? And so I'm here in Pittsburgh. We can probably fit 4 or 5 properties in that one entity under that mark of $1 million. So it's going to be very dependent on where you live. But just keep in mind, every time you do get one of those new entities, you've got to file for that and you've got admin costs for that. And potentially can become challenging on reporting. So when you start to do P&Ls, balance sheets, it just gets a little more complex then. So protection is great from that side, and there's absolutely nothing wrong with that. If you're probably having a $1 million property in Malibu there, admin costs are probably not your biggest concern then. So it's just cost benefit analysis on that. Yeah. The big one here then is your management company with your S-Corp. That's going to basically hold everything below that. And that's where you pay yourself out of. That's where the distributions come from. And so you can get taxed a little lower on the payroll side there. So it's got really good protection layers following this model, but you're also then maximizing it from a tax side.
Got it. And you can practice in every state. You're well versed in California, Texas, New York.
Correct. Yeah, we can work in every state. We're licensed throughout the whole U.S. Just no Canada. That seems to be the one we get a lot on. And a lot of times we have the agent clients who they're working in both, or they're helping clients move over here. We just can't do Canada. Yep. Next, now we start to get into the long-term strategies, and we want to start talking about retirement contributions. So we encourage our clients through the framework to go create a self-directed vehicle. That solo 401k self-directed is where you can actually park retirement funds tax-free, but also divert those into real estate. So in this case, we had this client contribute about $28,000 of that $125K they make a year into their retirement funds. And so if you remember, we're paying ourselves that $48,000 salary. That $28,000 is not included in that salary. It's coming off before that. So initially clients kind of freak out about this part. They're like, wait, you want me to put like basically a fifth of my pay into retirement? But if you go and push that into your salary, and now that salary is up in the 70s, you're going to probably pay about $20,000 worth of taxes on that new salary range. So that's why that salary optimization is so critical. We're going to take that money tax-free and park it for the long term, or park it into an asset. We can go and take now through that self-directed vehicle, and we can go find a deal, and we can purchase that deal, a real estate deal here, with what the money into that retirement contribution. So we've saved about $2,500 in taxes by doing this, but we've also put $28,000 away for long-term revenue generating wealth by buying an asset that, one, we can depreciate, two, will pay for itself by the renters, and then working the debt service calculation on it. So this is where it gets really creative on here, where we're setting ourselves up for the long term, but also creating a massive tax advantage for the current year.
Perfect, man. I like this.
Yeah. Just some rules on this side. If you do a solo 401k in 2026, 72K is the max on that side. If we do the SEP IRA, it's a 25% of your salaries there. So just make sure you know those, so you're not, putting too much in that, won't really help from a tax side.
Why do you think some? I'm going through this, and you went through some of this last time, and I had a lot of questions for you. But why do you think some of the CPAs we go to just don't talk through some of these things that we can do?
Yeah, I think it's just they don't know the full strategies. So they're not fully comfortable with talking about things like self-directed. They're not fully comfortable talking about things like cost segregations, which we'll get to. So they just want to keep things very set and standard. And so it's easy for them to get through a return by following kind of that same model. As you can see from this side too, you do have to be proactive in this. And a lot of the CPAs out there, they're just filing shops. And again, nothing wrong with that at all. But to go through this model, it does take ongoing prep and ongoing strategy of that side. Yeah. All right. This is where it gets really cool from a real estate perspective. Because most people on this call are agents, you are likely finding a real estate property for a client right now. Yeah. You probably know which ones are great in your neighborhood, in your market. So go find that property, and you can take that self-directed and use it to purchase that property. We can get very creative with the BRRRR model, where you don't have to use any out-of-pocket money to actually purchase that asset. We had this client find an asset that was worth about $245,000. They performed the cost seg study on that. We'll talk more about cost segs here in a second. They applied bonus depreciation through the One Big Beautiful Bill. That created a bucket of about $119,000 of depreciation that they can now deploy. Where this gets really cool is we mentioned the husband and the wife on this one had a W-2. If you're a real estate professional and you're able to elect that on your taxes, your real estate losses can also help offset active income from W-2 for you and your partners. That's where this gets awesome. So now what your partner has made through their standard W-2 jobs, you can use that bucket of 119K depreciation to slash their bill as well. With that asset too, it is going to appreciate over time. We estimated here in about 5 years, it'll be worth probably another $20,000. And you put a renter in that asset who pays down the mortgage. So you're not too worried about, out-of-pocket expense, because the mortgage is getting paid down, and you're setting the rent payment up. So you're actually getting some passive income on that as well. If the mortgage is $1,000, you rent it for $1,250. You're now making $250 passive. Rent has been paid down. Asset is depreciation. You've got this bucket now of depreciation that we can go and slash tax bills on.
I like this one, man.
Yeah, number 4 is probably where you really see the system start to stack and all work together. And then a couple of things on that real estate professional status. How do you make sure you can contribute to that? One, you need 750 hours of active real estate activities per year, and 50% of that time has to be within real estate. So track your hours, use things like your Google Calendar, your Outlook calendar, keep all your meetings on there. That way you can go through and easily say, hey, I was at my listing appointment for an hour here. I had an open house for 3 hours here. It's pretty easy for our real estate agents to track their times. If you have things like CRMs, it's probably using your call logs as well. So typically the 750 is pretty easy for them to track. You just also have to make sure 50% of your service time is in real estate. That's where some of our clients who maybe it's a part-time job for them, they still have like an active W-2 and they just sell a couple houses on the side. They might not be able to qualify for that then because it's not going to get them to 50% of the service time. And then, of course, all those activities on the side, their work. I know we got a lot of agents on the call today, so we'll keep it focused to that side. But anything on there does count towards those hours.
Perfect.
Yep. Cost segs, maybe the most common question we get is, hey, how do I perform cost segs? And something everyone on this call as agents should encourage is if you are investor clients, you should recommend them to get cost segs. It'll give them a ton of tax benefits, and they're likely going to want to go buy another house from you, and they're going to have extra cash to be able to do that. So really understand the cost seg for your portfolio clients. So what the cost seg does is it takes that asset, breaks the normal straight line depreciation that your CPA is likely taking over it goes normally over 27 and a half years. They take one fraction of that throughout that life cycle. Through the cost seg, you accelerate that into smaller buckets. Now you get that into 5 to 7 years. Once one big beautiful bill kicked in, you could now do the full accelerated depreciation. You can take that in year 1. So the upfront cost of purchasing that property basically can be pulled in and offset through depreciation in year 1. It's massive if you want to grow and scale a portfolio because a lot of those upfront costs get eliminated. Your tax bill then gets eliminated. And we're seeing clients essentially rinse and repeating this model year after year. So you can create that bucket of depreciation, slash it off again, you and your partner's active incomes, get that growing asset, and then do that every single year. And so
this is really, really good, man. I love this. And I think the more agents understand this, they can lead with this as well in some cases, which creates more opportunities for the agent. Julie's got an interesting question. My husband is a general contractor and I'm an agent. Can this help us?
Yes, but you can't combine your time. So if you're working 250 and he's working 5, it doesn't count as a total 750. It's got to be individuals on there. Likely, again, if your husband's a contractor and he's operating, he's going to cover that 750. And if you're a very active agent out there, you're probably going to cover that 750. But you got to do it individually. It's not a team hour rate there. Yep. We get this question too. Again, this was all part of that one big beautiful bill. That's really making cost seg super powerful because you can get that massive first year deduction up front, allowing almost 100% there. So you can see the note there. Our Burr model investors, this is where they're really, really utilizing the cost segs over and over and scaling and building out portfolios, super quick. Last one for you guys here. These are the ones that everybody should be doing right now. These are the low-hanging fruit strategies. So one, document a true accountable plan for your S-Corp and understand what expenses you should run through your business. Can't tell you how many times we see, the intermingling of a business account and a personal account, and you're not running things like your cell phone or your laptop through the business. You're not documenting things like travel meals and entertaining meals for clients that you should be running through your business. They're paying for all that post-tax. You want to run those through your business. So separate out your accounts. Make sure you have a dedicated business account and the right expenses run through that. Do not mix your business and personal. It's a pain from a tax side. It's a pain from a reporting side. and you'll likely leave deductions on the table, whether, hey, was my Starbucks receipt me grabbing coffee, or was that me out there with a couple clients? So you'll leave money on the table that way. So really understand your accountable plan. Implement the Augusta rule. The Augusta rule is where you rent your personal home to your business for up to 14 days a year, and you just find what the neighborhood rate is for rentals in your area. Charge yourself a fair market value on that. Malibu is probably a little bit higher than the day rate here in Pittsburgh, but that's great. Whatever the market is, you're able to do tax-free. Couple things on this one. Make sure your business entity pays your personal account. That way you have clear transaction that actually happened. And then you have to do business in your house. So you can do things like hosting clients, hosting team parties, team trainings, annual plannings. You just got to actually document the meeting and make sure it happens in your house. And this one is a super easy one to implement. Everybody can go and do this right away. Even now, like we're into August, which is crazy. You still got plenty of time of the year to make sure you get this one complete, but you don't want to be that guy on, end of December trying to sneak that in. When we talked about the client earlier, we knew that they had 2 kids. This one's really important because you can actually put your kids on payroll, and up to $15K a year can be done tax-free. That can go into things like college savings, a checking account. You can set up self-directeds for your kids. And if you want to go and buy that asset, you can joint venture that with your kids all through self-directed, which is a really cool, powerful way to set them up for the future too. Get them into investing and, get some assets under their name. This is key that you got to document the job, have a true job description, and make sure it's something they're actually able to do. So like my 6-month-old probably shouldn't be listed as, landscaping for my rental property. But what's cool about that now is through NIL, if any of the college sports fans are out there, I could pay her for name, image, and likeness. So if I'm putting billboards up, if I'm doing TV ads, if I'm doing social media ads, Facebook ads, I can include her in it, and I'm paying her essentially as a model or, name, image, and likeness on that. And that's a job description that she actually can fully complete, even at 6 months. We're seeing a lot of our clients with, teenagers that they do things like the landscaping and some, snow removal, that type of stuff, reasonable jobs for teenagers. Just document it, get them into your payroll process, and make sure it's something they can actually do. So in this case, by knocking out these 3, we found about another $4,000 worth of annual savings for them there.
It's about finding all of these little things, man. It's so crazy.
Yeah,
exactly. Yep. Yeah. So went through the definition of the Augusta rule there, but here's where the system all starts to work together. Entity structure and wage optimization, we got 6.5. Retirement contributions, an extra 2.5. Bonus depreciation, another 5.5. Low hanging fruits, 4.5. That's all money that you can keep back in your pocket. So you can maybe go hire that VA. You can go get that software subscription you need. Increase marketing spend, all different things you can do to help bring money back into the business. Here's more info on just how you guys can get a hold of us here at Accruity with the QR code. We'll do a free strategy session for anybody on this call. We'll just kind of talk through some of this stuff that might be more one-on-one setting and how it's applicable to your business. Again, a bunch of services we can offer, things from bookkeeping, entity structuring, financial reporting, your payroll, your ARs, your APs. Of course, tax strategy, tax filing, that's what most of our clients are coming to, but we're meant to be a full service, real estate focused CPA, accounting, and finance shop. So if you're interested, you have needs in any of those areas, please scan this, book a call. Love to chat and see where we can help you out at.
Perfect. Please scan the QR code. And Sarah, thanks for being on. She says, great info. Thank you. My husband and I were just talking about finding someone like this. So this is timely. Sarah, we love Alex. When we first found him, we're like, whoa, where did this guy come from? And where did this company come from? Because we didn't know it existed. So that's pretty cool, man. Thank you for doing this.
Absolutely.
Before I let you go, I want to give what would you say, Jason?
I'm just saying lots of great information. I mean, it's, and it's not just for us, it's showing our knowledge of helping our clients.
For sure. Yeah. It's real estate professionals, particularly the agents. It's like the one occupancy out there that has its own tax designation. Like, accountants don't get discount on their taxes, but real estate professionals have set up this whole ecosystem of utilizing the things you're doing every day that have tax benefits to it, all, within the laws and all above the line. You just got to get used to taking advantage of it and put yourself in the position to start to do some of like the investing and some of the retirement contributions. Maybe is a little bit out of the norm or out of the usual that clients are comfortable with, but you're going to save a ton of money by doing that. So it's okay to get uncomfortable with some of that when you see the money back in your pocket.
Yeah, definitely.
And there's a lot of questions on cost segregation. So you may get that. And you know what we could do, Alex, in one of our sessions, we could probably go deeper on cost segregation if you want to make one of those slides.
Absolutely. Yeah, that'd be great. We help run cost segs, in-house. There's a couple different ways you can do cost segs with like lower touch models for single family homes. Sometimes if you're into multifamily or commercial, larger buildings, it's good to have an engineer come out, but we can help make all the recommendations you would need on those.
Perfect. And then one more question for you. So if I employ my 13-year-old, what records do I need to keep?
Document the job description, track their hours, make sure they are part of your payroll process. So like, don't pay them cash, document that, you're actually getting them on there, and just make sure, again, it's feasible and that you document everything. With everything we talked about in this deck, documentation is key. Just make sure it's defensible. There's always a risk of an audit if you're running a business and you're filing taxes. So if that ever happens, you can go and say, yes, I have a 13-year-old and they spend, 2 hours a week mowing the lawn for my rental properties. It's Tuesdays at 4 o'clock to 6 o'clock and I pay them $20 an hour. Go into your payroll process. They would see that transaction happens and those hours all match and, you're in good shape. Don't pay them $1 million to cut grass, keep it within that limits there of the tax-free side and make it a reasonable wage. And you're all good.
I love that, man. I'm just going through making sure I didn't miss any other pertinent question. A few on the cost segregation, which you already knew. Do you work with Section 8 properties?
Sure. Yep. Yeah, we can work with any property. There's some HUD work that just needs done with those ones. That's a little bit different than, the non-Section 8. But yeah, we've got models that work for HUDs as well.
And I know this will probably be something we talk about later, but can you go over the wholesaling process? So if somebody has a lot of doors they own, we could probably touch that on cost seg later on.
Sure. Yeah. And what I would recommend if you're wholesaling is our wholesaling clients are probably the ones that need accounting help the most because it's just a very unpredictable, job, right? You might have 10 deals 1 month and then go two months without finding one, and forecasting and understanding how your money can stretch out, that you got this big deal today and you go spend it all on marketing, or you go hire that assistant. And then we see at the end of the year, they're like, I didn't save anything for taxes. Yeah. So forecasting is so critical for the wholesaling clients out there because the revenue stream is probably the most unpredictable of any of the verticals we support. So that's definitely a really good accounting exercise we want to get our wholesaling clients into.
All right, Alex, thank you so much.
Appreciate it, guys. Thanks for having me. Good to see you guys.
Never had coffee. Don't hold it against him. Don't worry. You can trust him.
You would never know he never had coffee talking about it.
I know, Alex. Thanks for being on. Everyone, thanks for coming through this whole virtual event with us.